So this is an emergency market update because something big is happening right now. AI stocks are selling off, Bitcoin is selling off, and both are pointing toward a major correction that might already be underway. And listen, even if you're not into Bitcoin, this still matters because Bitcoin has historically acted as a leading indicator for the entire market. It started going down before anything else, and that alone should make everyone pay attention. There are a lot of theories floating around about what's causing all this. Some are technical, some are macro, and some are honestly pretty wild. But one of the most interesting explanations I've come across comes from the technical side of things, and credit for this goes to Benjamin Cowan. If you're not following his channel, you absolutely should. It's one of the most fascinating places for deep, data-driven analysis. One of the biggest things I learned from him is the significance of Bitcoin falling below the 50-week moving average. Once Bitcoin breaks under that level, historically the bull cycle is over. The good days are done. That 50-week average this cycle was around $13,000, and a couple weeks ago, Bitcoin slipped under it. That triggered a flood of selling from investors who take these indicators seriously because, to them, the prophecy was basically fulfilled. And what makes this even crazier is that this happened while everything else around Bitcoin actually looked good. We got regulatory clarity. Companies were adding Bitcoin to their treasuries. We got favorable Bitcoin legislation news. Even Harvard University bought hundreds of millions of dollars worth of Bitcoin. Everything around it said the price should be climbing, and then it didn't. So the big question is why? And how does this impact everything else happening in the market? In this video, I want to break down all the best theories that explain what's going on, so you have a clearer picture of what may happen next. Before we dive deeper, hi, my name is Audrey Jick. Hope you're doing well. Come for the finance and stay for the market. Let's start on the technical side because honestly, this is one of the most convincing explanations out there. And again, full credit to Benjamin Cowan, who has absolutely nailed these patterns. Technical analysis is based on the idea that markets behave like social systems. When certain patterns appear, they trigger predictable reactions, and Bitcoin is a great example of this. Check this out. The time it takes for Bitcoin to run from the bottom of the market to the top has been almost identical in every cycle. Roughly 150 days from bottom to top. And what's even more fascinating is that the opposite swing, top to bottom, has also consistently taken around 364 days. Bottom to top about 150 days, top to bottom about 364 days, repeating across multiple cycles. In this current cycle, the bottom to top timing also landed right around that 150 to 164-ish day window, which implies that if the pattern repeats, then 364 days from the last all-time high, which was October 6th of this year, would put the next all-time low somewhere around October 5th, 2026. Now, whether you believe technical patterns or not, this is compelling enough that it shouldn't be ignored. That's theory number one. Theory number two also comes from the technical side, the 50-week moving average. When Bitcoin is in a bull market, it stays above this line. When it breaks below, the bull market ends. We dipped below that level roughly $13,000 and stayed below for several weeks. Historically, that has never been a good sign. Now let's zoom out and look at the macro side, because according to this explanation, what's happening right now has nothing to do with charts. Instead, it has everything to do with global liquidity, the invisible force that moves all markets. Example number one, Japan. For decades, Japan has acted as the world's zero-interest lender. Their interest rates were so low that investors could borrow yen almost for free, convert it, and invest it into higher yield assets like U.S. Treasury bonds. That spread was an easy, almost guaranteed profit. This was the carry trade, but now Japan's interest rates are rising. And when the cost of borrowing goes up, the carry trade unravels. Suddenly, Japanese institutions have a reason to bring their money home. And when you unwind positions, you sell dollar-denominated assets, everything from stocks to bonds, and bring that capital back to Japan. That's a huge shift in global liquidity. Then comes liquidity change number 2, the Fed ending quantitative tightening. Ending QT sounds good on paper, but historically, the Fed only stops tightening when something in the financial system is showing cracks. They won't publicly say that, but investors know the pattern. They see slowing job data, weaker consumer spending, and a growing divide between high-income and low-income Americans. So instead of seeing the end of QT as good news, they see it as the Fed trying to prevent something worse. That uncertainty causes risk assets to sell off, and Bitcoin always moves first because it's the most liquid. You can sell it on weekends, you can sell it instantly, it reacts before everything else. Now we get into theory number 3, which has nothing to do with global liquidity or charts. It's about psychology and internal conflict within the Bitcoin community. The short version is that Bitcoin has been experiencing a kind of identity crisis. OG Bitcoiners believe Bitcoin should only be money, but a development update expanded the size of data you can attach to a transaction, making Bitcoin able to store pictures, videos, and files, essentially turning it into a data protocol. This sparked a massive debate. Some fear it opens the door to spam, illegal files, and bloated block sizes that threaten decentralization. And the controversy got even louder when people started pointing out that the development team behind the update was allegedly funded by questionable sources. That alone caused some longtime holders to step back and sell because they don't want Bitcoin drifting from its original purpose. Finally, theory number 4 ties everything together. This one comes from Jordi Visser, and he explains that Bitcoin is essentially experiencing its IPO moment. Not an IPO like a company, but an era when early investors finally have the liquidity to cash out. Before ETF existed, if someone holding $1 billion worth of Bitcoin tried to sell, they would tank the market instantly. Now they can sell to institutions, funds, and even countries without crashing the price, and that's exactly what's happening. We've seen wallets unload hundreds of millions. We've seen Galaxy Digital process a $9 billion sale for a single wallet this year. These are early adopters finally exiting, not because they hate Bitcoin, but because the liquidity is finally there to make it possible. This doesn't happen in one day, it happens slowly, over months, maybe a year, and it lines up with that 364-day correction pattern we talked about earlier. So here's what I'm personally doing. I'm not selling my Bitcoin. I think it will survive these internal debates and external pressures because financially, the incentives always realign. I'm also not touching my stock portfolio. My long-term and dividend portfolios continue to pay me every month, and historically, they hold up even in sideways or declining markets. If we really are heading into a period of slower growth, I'll continue dollar-cost averaging just like always. The funny thing about all these theories is that if everyone knows them, will they still come true? I have no idea, and honestly, all 4 theories are probably true to some extent. Some carry more weight than others, but figuring out those weightings is impossible. All we can do is make the best decisions with the information we have. So those are the biggest explanations for what's happening right now. I'd love to hear your thoughts. What theory makes the most sense to you? Let me know down below. Hope you have a great day. Smash the like button and subscribe if you haven't already. I'll see you next week.